in part 1 of this lesson, we will go through all these past year exam question. Please get ready all the past year exam question, get it in front of you. Okay, so now this is 2008, the new syllabus of 2008, paper 2, question 5. Okay, so now we look at this question. I know, I mean, if you follow me now, I look at this question also, I blur already. Don't know how to start. So that means now I will so-called roughly browse through this question like this, and then I see the required here, what the question wants. You say prepare a profit and loss and appropriation account for the partnership for the year ended 30 September 2008. Prepare the current account for Ahmad and Bashir for the year ended 30 September 2008. C. Prepare the balance sheet. Okay, so roughly now I know, have an idea what is it all about. So you all would have gone through all the previous lessons, including the lessons on doing the sole trader final accounts, profit and loss and balance sheet. So partnership is slightly more complicated and more difficult than sole trader final accounts. Okay, so now it says there Ahmad and Bashir are in partnership. The partnership agreement allows interest at 10% per annum on their fixed capital account and allows or charge interest at 8% per annum on the opening balance of their current account. Bashir is also allocated annual salary of 13,000. They share residual profit equally, except Ahmad guarantees Bashir a minimum total profit share from the partnership of 56,000. Following is the trial balance prepared at 30 September 2008. Okay, so this is the trial balance at the year-end trial balance, and then you have all this additional information. Okay, so roughly now you would have so-called have an idea what is this question asking about. So now I will use the same way to go and lay out my question first. So okay, you have the question paper in front of you like this. So now I'm going to look at this question paper rather than scrolling up and down. So part A of the question says prepare a profit and loss and appropriation account. Okay, so this one, so that means now I put here A, Ahmad and Bashir, profit and loss account for the year ended 30 September 2008. Because profit and loss and appropriation account, you in A level you should do it in the statement format, not the T account format. Okay, do it in the statement format. So I would like to spread out. So this one, profit and loss account, then here again A, I'll put appropriation account for the year ended 30 September 2008. So that means you go and tear out all the blank piece of paper like this and just do it Ahmad and Bashir and do the title. Then this one appropriation account. Then put here $sign. Okay, so step by step is not difficult. Otherwise you don't even know where to start from. So go step by step. Take all your blank pieces of paper, tear, and then do all the title and put a 2 column like this first. Okay, then part B says prepare current account for Ahmad and Bashir. So you put your current account. Okay, then put current account, you do in a T account format. Okay, do in a T account for Ahmad, and then Bashir, and then $sign. Okay, laid out your structure like this first. Then part C says prepare a balance sheet. Okay, so in the previous lessons I have taught you how to do the balance sheet in a statement format, but over here I did not modify this, redo this again, because over here it's easier for you to see. No need to scroll so many times when the balance sheet is in this format. Just that when you are do 2 pieces of paper, this column 1 piece of paper, another column another piece of paper for all these things. Okay, so balance sheet, like what I have explained to you. Okay, Ahmad and Bashir balance sheet, then Then you lay out all these things. Fixed asset, cost, accumulated depreciation, net book value, $sign, $sign. Then leave about half a page, current asset, then underlined. Then at the bottom of the page, draw 2 lines like this. Then another piece of paper. Okay, so you see, when we do company accounts or sole trader accounts, we have equity. Okay, this one. So I may have left out here. You can just do equity, then underlined. Even if you left out, is not a very big major mistake. So you just write here equity, underline. Okay, then you put here capital accounts. Okay, and then current accounts. Okay, this one, capital accounts. That means for partnership. You see, for partnership, these 2 person are partners to do a business, like you and your friend, like that. Like you and your friend. So you all have like committed 100,000 as long-term funds for your business. This one Ahmad 70,000, and then Bashir 30,000. So the long-term funds we will put in the capital account. So that means so-called that's why it's the long-term funds committed to the business. Then all those that, like the salary that is supposed to pay to the partner, or the partner's drawings and the partner's share of profit, all these things, we will put into the current account. Okay, I know in the sole trader you have a beginning capital, then add profit for the year minus drawings, then ending capital. Okay, easy. But for partnership, we segregate the long-term funds with the current funds. Okay, that is committed to the business. The long-term funds, these two partners say we will commit this 100,000 into this business as long-term funds. Unless there's something major change in the company, I mean in this business, or they want to close down the business, they won't touch these long-term funds. Then if they want to take out any money from the business, they take out through their current account, and the share of profit will also be added to the current account. So capital account and current account together is the partner's equity. Okay, partners as apostrophe, this is plural. Then okay, so that means you put your capital account dash who was the partner, Ahmad, and then Bashir. You can leave it blank first, then current account. Okay, then here partner's equity. Then after that you leave quite many lines, or around half a page, and you put current liabilities. Then at the end of the page you draw 2 lines like this. Okay, then parts. Okay, so that means I have laid out. Okay, now you see we have laid out A, B, C. Okay, don't find me too long-winded, because if you follow me like that, the challenge is if you off the video later, and then you should take out all your past year exam question. Don't go and keep looking at any suggested solution that you have. Do independently like you are supposed to do in the exam. Okay, so if you can do independently, perfectly correct. Let's say you say no need to go through all this lesson, waste of time. So waste of time. Okay, then you take all the past year exam question, answer the question like a pro, perfectly. Then no problem. You don't need anyone else. You don't need any person to share the knowledge with you. So you can just confidently go ahead. Okay, so right now I am just trying my best to share whatever experience and knowledge that I have over here. Okay, so profit and loss account. So that means now you look at the question paper with you, all this question paper with you here like this. Okay, so that means now when I look at the question, so it says that Ahmad and Bashir trade in partnership. Their partnership agreements allow 10% fixed capital and whatever. Okay, the following trial balance has been prepared at 30 September 2008. So capital account, Ahmad and Bashir. Then I look at the additional information 1 to 5. Additional information 1 to 5. So all this. So it says here, prepare the profit and loss account. So that means, in other words, prepare the accounts at 30 September 2008. So here, number 5, they say Cherry joined with effect on 1 October 2008. Okay, so here investment, presented check, all these things, stock. So that means now I will fill in the easy figures, first. So here, capital account, Ahmad and Bashir. Okay, so that means once you have laid out all your answers, it's not that difficult. So you have put your capital account. So Ahmad's capital account is 70,000, Bashir is 30,000. So then here you put a subtotal here. So then now, how to do the current account? Okay, so this is a current account. You see, current account is under the credit side of the balance sheet. So what does this mean? That means so-called the business, the company or the partnership owes the partners money, owe the money to the partner. So that means the current account, you can think of it as if it's something like a creditor account, So that means the question, it says here, current account, Ahmad, bracket 1 October 2007. That means the current account balance at the beginning of the year, you see, balance brought down will be on the credit side, because the balance brought down is always same side with the balance sheet one. It's always on the balance brought down is always on the correct side one. Okay, so current account, if you look at the question, Ahmad is 10,000. You see this one, the question, so this is a trial balance. So that means this side is debit, this column is credit. So current account, beginning balance of the current account for Ahmad, this is a credit balance of 10,000. So this is the balance brought down, will be 10,000. Okay, then the balance brought down for Bashir will be 7,000. Okay, so just take from the question. Then drawings is, okay, this one, drawings 52,000. You see, in the question, the drawings is on the debit column, so put in the debit column like this. So what can you understand with this current account? First of all, you think of this account as something like a creditor account. Okay, so let's say you put yourself in the shoes of this partner. So let's say if I'm Ahmad, let's say if I have if you credit the Ahmad, credit the amount, the money in the Ahmad current account, Ahmad will be happy, That means they say that he will have that means the company will owe him more money. That means he have more money inside the company. So Ahmad is happy. So if you credit the partner, the partner will be happy, correct? Because that means the partner will have more money in his current account. So but if you debit the partner not happy, because that means his money less already inside the company. So that means if this one, Ahmad and Bashir drawings, that means if they have taken out so much money from the company, they will have less money in the company. So they won't be so happy because their money become less. Okay, so drawings, as you can see from the question, is on the debit column, and also drawings should be on the debit side. So that's how I get this drawing 52,000 and 42,000 is obtained from the question. Not difficult, because we are just putting whatever easy number first. Okay, so then if you look at the additional information number 2, it says additional information number 2 says that stock value at 3,000 has been taken by Bashir for his own use during the year, and no entry has been made to record this. Okay, stock value at 3,000 has been taken by Bashir for his own use during the year, and no entry has been made to record this. So that means he is indirectly taking out money from the company for his own use. He is not taking out money, but he is taking out stock, which is also like indirectly taking out money from the company for his own use. So in the current account, this 3,000 is also drawings lah, because he didn't take out cash, but he take out stock. The company buy the stock, the company purchase the stock, and he take out the stock that is purchased from the company for his own use. So that means this one is 3,000 is Bashir take out. So that means must debit the Bashir current account, put in the debit side. Drawings, I just put here bracket stock taken 3,000. Okay, just now I said that this one Bashir take out 3,000 from the company for his own use. Take out 3,000. The company purchased the stock, and then he take out 3,000. Okay, so that means now we come to here, profit and loss account. Okay, we have sales. Sales is 360,000. We copy from the question. Then after that we have cost of sales. Okay, we have cost of sales. Here is 170,000. Okay, so if you have watched video of lesson 2 before, I have explained perpetual stock system. Perpetual stock system, where what is this perpetual stock system? That means you will have a cost of sales, and then you will have the stock account. Okay, so that means you will have in a perpetual stock system. Okay, I just recap you a bit. Those who have watched the video, probably you may not recall so easily. Okay, so that means in a perpetual stock system, you will have a cost of sales account. So this one, in the question here, they just put one cost of sales, right? They just put one cost of sales. So in the periodic stock system, you know that you have purchases. Then the closing stock, it will be outside the trial balance. That means it will be under the additional information, because closing stock is after you do everything, you count the stock, then you get a stock value, you go and debit to the balance sheet, the under current asset stock, and then you go and credit to the closing stock under the cost of sales in the profit and loss account. Okay, so but in the perpetual stock system, you only have one cost of sales and one closing stock. So that means when you buy the stock, when you buy the stock, the figure would be in the stock. Okay, so you see the stock in the question 30 September 2008 is 35,000. Is 35,000. Stock at 30 September 2008 is 35,000. Okay, so Bashir took out 3,000 of the stock during the year, and no entry has been made to okay, you see, this one is the perpetual inventory means stock, perpetual stock system, that notes that I have used to explain to you in lesson 2 earlier on. Okay, you see, perpetual stock system, you will have one cost of sales account, and then you have the stock account or inventory. Another name for stock is inventory. So the stock means the balance sheet stock. Okay, you see in your question paper, there's this stock account 35,000, 30 September 2008. That one is the balance sheet stock. Okay, so you will have one cost of sales account, but in the periodic stock system, or the normal one, or the periodic stock system that you learn in O level, that one, you will have opening stock, add purchases, less closing stock. But in the perpetual stock system, no such thing. Only one cost of sales account, and then one stock account. Okay, in the stock account, the debit side, stock is a debit in the balance sheet. So when the stock come in, you record in the debit side. Okay, when the stock go out, you record in the credit side. Okay, then in the cost of sales, when the cost of sales is incurred because the stock is sold, because when the stock go out, right, that means the cost is incurred. When you buy the stock, the cost is not incurred yet, because you buy the stock but you haven't sell the stock. The stock is still in your store. Let's say if for example, if the stock cannot sell, you so that means the stock haven't sell lah. So the stock haven't sell. Let's say ultimately the stock didn't sell. You buy already, the company closed down, you still can sell the stock and then get back your money. So that means the cost is not incurred yet. Okay, so this one is the stock account. That means the balance sheet stock. Okay, on the debit side, this one bank, because you pay money, right, when you buy the stock come in. And then when the stock go out, you put on the credit side here. Okay, so that means when you sell the stock, you will incur the cost of sales. You will incur the cost of sales when you sell. When the stock go out, that means when you sell the stock. So that means this 2,000 stock that is sold, the value of this stock will be go out from the stock account and transfer to the cost of sales account. Correct? The cost of sales account. Similarly, when you sell at 4,000 on August 31, it will go to cost of sales account. And at the end of the year, this 6,000 will be transferred to trading account. Will be transferred to the trading account. 6,000. Okay, 6,000. Okay, so that means now this 6,000 will transfer to the trading account here. Okay, cost of sales. So now from the question there, we now look at the question. We have some sort of like a idea already. We have some sort of like of an idea, because you see the this one Bashir took out 3,000 of the stock for his own use. Okay, the look at the additional information. Stock value 3,000 has been taken by Bashir for his own use during the year, and no entry has been made to record this. So now we think of it a bit logically. The 3,000 was not recorded, was taken out, from the stock account, but not recorded. Okay. So that means it should record in the stock account on this credit side. It should record in the stock account on this credit side. Okay, but it should not. That means it won't be like here put cost of sales. You know why? Okay, so that means first of all, you should minus away from the stock account. That means he was taken out from the stock. So that means the closing stock would reduce by 3,000. So you see in the question, the stock 30 September is 35,000. So he took out 3,000 from the stock, and it was not recorded in the stock account. So that means the stock account will be 32,000. So that 3,000, is it supposed to correspondingly transfer to cost of sales? Is it correspondingly transfer to cost of sales? That means so-called increase the cost of sale. You think again. That means you see, like normally when the goods is sold, for example 2,000 of the stock is sold, you transfer to cost of sales 2,000. But the partner go and take out 3,000 from the stock. Okay, so correct, you will put it on the credit side of the stock account. That means you minus from the stock account 3,000. But where is this 3,000 go to? Is it supposed to go to cost of sales? But it's not a cost of sales, right? The business owner take out and use for himself, right? Correct? The business owner take out and use from himself, right? So that means it should be here. That means that 3,000. So that means that 3,000, for example, it should be not cost of sales. It should be correspondingly debited to drawings are like this. Correspondingly debited to drawings here 3,000. 3,000. Okay, you understand or not? Because the 3,000 is okay. Should he take up from the stock? He take up from the stock, but he take up for his own use. So it's not a business cost. It's not a business cost. Is he indirectly take up money or take up resources from the company for his own use, correct? So that means it should be debited. I mean, yeah, it should be credited to stock because it reduced the asset. Yeah, and so it credited to stock, right? Reduce the asset, right? And reduce the partner's equity. Reduce the partner current account. Okay, he did not reduce the capital because capital is for long term. I tell you, capital is for long term. Capital account is for long term. Current account is for current current use. Okay, so that means these drawings are these drawings 3,000 will be put in the partner's current account. Okay, so that means you credit the stock and then you debit the drawing. So that means, in other words, you reduce the stock in the current asset, and also you reduce the current account, reduce the so-called the total equity of the business owner. That means the business owner, in short, that means the business owner have less funds in the company, in the business, have less funds in the business. That's because he take up. So he did not take up from the bank, right? He take up from stock. So is also like indirectly take up from the bank. The company buy the stock first. Then after that he take up from the stock. So that means if he take up from the stock, so that means his money in the company will also become less. Right? Because he take up from the stock. So he take up from the stock, it won't affect the cost of sales. The cost of sales, that means the business cost. The business cost. Okay. That means the business cost. Okay. So that means he reduced from the current account. So this one stop. Okay, so that means now I have explained this stock. So that means the cost of sales won't be affected. The partner go and take some stock from the company for his own use. It won't affect the cost of sales, right? It won't affect your this one, the 本钱, correct? Your stock, the cost of your sales, right? The cost of your sales. Okay, so then this one, the 170,000 is just taken straight from the question. So sales minus cost of sales, you get gross profit. Then you see in the question it has investment income, investment. So that means you put add other income, underline. Okay, you can put investment income first or gain on either way is also okay. Okay, investment income here is 5,000, is from the question. Okay, then now okay, you can look at number 4. Investment was sold for 102,000 on 25 September 2008. But as the paperwork has not been received by the end of the year, the sale has not been recorded in the books. Okay, you see this investment that cost 90,000. So this one says the investment was sold for 102,000 on 25 September 2008. But as the paperwork has not been received at the end of the year, the sale has not been recorded in the books. So the sale is not recorded in the books. So the investment cost, that means this one investment is something like the shares. Okay, the shares, the cost is 90,000. You sold it for 102,000. So that means you take the calculator and count 102 minus 90. So that means actually the investment was sold for a profit of 12,102 minus 90. So that means in the profit and loss account, gain on sale and investment, 102 minus 90 is 12,000. So that means in the balance sheet, the investment is supposed to be recorded after fixed asset. Then you put here investment 90,000, but 90,000 gone already. It's no longer existent in existence as 30 September 2008. Okay, so the question says so that means the 102,000, where is the 102,000 now? The investment is sold for 102,000 at 25 September, and the paperwork. So that means if the 102,000 is in cash, that means maybe one of the partner hold this 102,000 cash in trust for the company. Then that means under current asset, you put your cash of 102,000. But from the question here, it looks more to me like this 102,000, I think is not received yet, because from what I look at it is hinting to me that this 102,000 is not received yet. So if it's not received yet, then it will be other debtors. Under current asset, I put here other debtors. Then I put bracket from sale of investment, 102,000. Okay, but if the question clearly states that 102,000 is already received, then but the money is held in trust, held by the partner in trust for the company, then you put here cash 102,000. Okay, so but it looks to me like the money is not received yet, so I just put here other debtors from sale of investment. So in other words, you debit other debtors 102,000. You credit investment. Okay, the investment is a debit, so it's out. So you credit investment 90,000, and you credit gain on sale of investment 12,000. So the journal entry balances. Okay, so I have completed until here. Then less expenses, underline. Administrative expenses. This one, administrative expenses, because in the question there, it is under note number 1, it says something like depreciation has been adjusted. Okay, so this one is a bit troublesome. I put here W1. And then I use a piece of paper, and I put here workings bracket W, and I hold on first lah. Okay, administrative expenses originally in the question is 42,000. This one wait lah. This one it seems like a bit difficult. Why don't I do the easy one first? In the exam also I'll put in all the easy number first. So distribution expenses 63,000. This one no adjustment. So you see in the question, the trial balance, there's administrative expenses, there's distribution expenses. No other expenses. So that means I can safely assume that depreciation is actually included under administrative expenses. Otherwise, where else can it be? So distribution expenses 63,000. Then I can maybe leave one line and then draw one line. Then I hold on first. I can put the bracket first and I don't put the number first. Then I put net. Don't know whether profit or loss, and I draw the double underline first. Okay, so then here either net profit or something, then I put net. Okay, this one, appropriation account. Okay, profit, this is profit and loss account, then you arrive at net profit. Then you come to this appropriation account. What is appropriation account? Appropriation account is something like how you go and share the profit, how you go and allocate the profit to the partners. Okay, now you see this one, profit and loss account. Okay, profit and loss account, you take all the income minus all the expenses, then you get your net profit. Then when we continue in the appropriation account, okay, this is the net profit. We will add all the income that is given. So you see, this one income, other income. So this one sales. That means in the profit and loss account, this income is gained from outsider. It's gained from outsider. But in the appropriation account, all this one add, right, net profit add, this income is gained from so-called the company gain from the partner. Okay, so that means the company profited from the partner. So that means from the company or from the business, the partnership, the business point of view, is a good thing, it's an income from the business point of view. Okay, so that means the partner so-called pay to the pay to the company. And then here less. So that means this one is an expense, but this expense is expense to the partner. That means it's pay to the partner. So that means in the appropriation, in the profit and loss account, is all the income is from the outsider. In the appropriation account, all this income is from the partner. All the expenses is to the partner. Okay. So you look at the question paper. Ahmad and Bashir trade in partnership. Their partnership agreements allows 10% on fixed capital account. So if you can put less interest on capital first, 10%. Okay, so this one is very easy. The Ahmad, the capital is 70,000, so 10% is 7,000. Okay, so that means this means that the company is giving the interest to the partner based on how much capital they have in the company. Okay, so Bashir capital is 3,000. So together, the interest on capital is 10,000. You can put interest on capital first, doesn't matter. And then also, so that means then what else? Then the question also say Bashir is allocated an annual salary of 13,000. So less salary, Bashir 13,000. Okay. So this one 13,000. Okay, then the question also say, look at the top part of the question. Their partnership agreement allow 10% interest on the fixed capital and allows or charge interest at 8% per annum on the opening balances of their current account. Okay, so if the current account is okay, so you see the current account, Bashir one is a debit balance, and then Ahmad one is a credit balance. So that means what you can think from here. So that means, in other words, at the beginning of the year, the opening balance, the Ahmad one is a credit balance of 10,000. That means the company so-called owe Ahmad 10,000. So that means the company, if the company owe somebody money, the company so-called must pay interest, right? The interest, as stated here, is 8%. So the company should pay Ahmad interest $800. 8% of 10,000 is 800. So the company should pay $800 of interest to Ahmad. And then here at the beginning of the year, so-called is a debit balance of 7,000. So that means at the beginning of the year, so-called Bashir is something like debtor, is something like a debtor. Is 7,000 debit balance. So that means, in other words, Bashir owes the company 7,000. Okay. So if the Bashir owes the company 7,000, that means Bashir must pay the company interest. Okay. And the interest is 8% as stated in the question. So that means the Bashir must pay the company. So to the company, it's a good thing. It's an income. Add interest on current account, 8%, Bashir. Okay. $560. So this is how I get my figures. So that means this one, net profit. Okay, yeah, we haven't get this net profit figures yet. Okay, we haven't get this net profit figure yet. But just let me explain first. So assuming when we get the net profit figure already, then add whatever minus whatever, then you get profit available for appropriation. Okay, so you see, all this is we charge the partner. That means the partner so-called supposed to give to the company, and the company also supposed to give to the partner so much. Okay, so that means you see, the thing is stated on top of the question that all this is supposed to be allocated to the partner. So this one has not been paid cash to the partner yet. Has not, all this is charged but not paid yet. So we will debit or credit this amount to the partner's current account. So that means this one, interest on current account 560. So that means this one partial, because at the beginning of the year, opening balance, partial owes the company 700. Well, so partial supposed to pay the company 560, pay to the company. So you see, in the appropriation account, we have credited 560, something like an income in the appropriation account. So the interest on current account has been credited to the appropriation account and would be debited from partial current account. Okay, so that means we are so-called this 560 would reduce the partial's entitlement or balance in the current account, will reduce partial's current account. Okay, because this 560 is supposed partial supposed to pay 560 to the company, so will deduct from his money in the company. Okay, then like just now I say interest, the $800 is the company will pay Ahmad, so that means will debit the appropriation account, then will credit. Because you see, when you credit the current account, the partner happy, you know, because give him the money, give him the interest 800, right? So because we haven't paid by cash, so we credit to the current account. Okay, then the salary also credit to partial current account. Okay, so now okay, interest on capital also credit to the, because it's give to the partner, so credit to their current account. So I explained all these figures already. Okay, good. Don't know how I explained so much already. Okay, so now the question says the fixed asset at cost is 80,000. And then the note number 1 says depreciation has been provided on fixed asset for the year ended 30 September 2008 at a rate of 20% using reducing balance method. The partners decided to increase the rate used to 25% effective from 1 October 2007, effective from the beginning of the year. Oh, how will this one die? Okay, so the fixed asset, the cost is 80,000. And then in the question there, it says accumulated depreciation, bracket note 1. Accumulated depreciation, bracket note 1, 48,000. So the 48,000 is the, okay, so this one is, wow, what is this? You see, the note number 1 says depreciation has been provided on the fixed asset for the year ended, has been provided already. So that means this 48,000 has included this year depreciation already. Included this year depreciation already at a rate of 20% using reducing balance method. The partner decide to increase the rate used to 25% per annum with effect from 1 October 2007. Okay, with effect from 1 October 2007. So you see, in the question there, okay, so that means you see, the fixed asset at cost is 80,000. Okay, fixed asset at cost is 80,000. Okay, so that means now I am using algebra method to solve this to solve this. Okay, so they are telling us that the accumulated depreciation, that means the beginning of the year accumulated depreciation plus this year's depreciation is 48,000. Okay, so that means now I so-called gather some idea already. So is it accumulated depreciation at the beginning of the year? We assume it's X. Okay, mathematics. So we assume that accumulated depreciation at the beginning of the year is X. Okay, so reducing balance method is we calculate the depreciation based on the net book value at the beginning of the year. So the net book value at the beginning of the year is 80 minus X. Okay, 80 minus X times 20% plus X, which is the accumulated depreciation at the beginning of the year, equals to 48,000, correct? Because the question says the accumulated depreciation is, bracket note 1 is 48,000, and this 48,000 includes this year's depreciation, which is charged at 20% using the reducing balance method. So that's how I derive this equation. This 48,000 will be the accumulated depreciation at the beginning of the year plus the net book value multiplied by 20%, which is this year's depreciation that has already been charged. Okay, that has already been charged and included in the 48,000. Okay, so now I have an equation. So I solve for X using algebra mathematics equation, right? So X is 40,000. So that means I know that the accumulated depreciation at the beginning of the year is 40,000. So now, if you use the new depreciation rate at 25%, 25% based on reducing balance method will be 80,000 minus the accumulated depreciation at the beginning of the year, which we calculated is 40,000. Then times the 25%. So the new depreciation expense is 10,000. Okay. The original depreciation expense is, this one 48,000 is inclusive of this year's depreciation, right? So 48,000 minus the beginning of the year depreciation, 40,000. So the original depreciation expense for the year is 80,000, but the new depreciation expense is 10,000. Okay, so that means this 42, the depreciation would have included in the administrative expense. So the administrative expense figure is 42,000. We minus the old depreciation charge, and we add the new depreciation based on 25%. Okay. Okay, so, and then now so that means the new accumulated depreciation will be 40,000 plus 10,000, and this 50,000 will go to the balance sheet. Yeah, 50,000, and so the net book value will be 30,000. Okay, then there is something else that we should adjust to the administrative expenses. Okay, under in the question under item number 3, by looking at the bank statement for September 2008, it is discovered that the following items has not been taken into account. Bank charges 10,000. Bank charges is an expense, so it should be included in the administrative expense, but it was not included. So now we include bank charges. So the new administrative expense figure should be 45,000. 45,000. So I put 45,000 here, and therefore I get 99,000. And therefore here I get profit available for appropriation 75760. Okay, then here, so that means this so-called profit available for sharing by the partners is 75760. So then share of profit, how are they going to share? Okay, the question says that on top of at the top of the question, Bashir, okay, so they share residual profit equally, except that Ahmad guarantee Bashir a minimum total profit share from the partnership of 56,000. Okay, so share of profit. So they are supposed to share this equally, but Ahmad guarantee Bashir a minimum profit of 56,000. So since if you divide by half, it's less than 56. So Ahmad Bashir will get a minimum of 56,000. Okay, minimum of 56. He said guarantee him a minimum of 56,000. If his share, that means I will interpret it as if his half share of the profit is less than 56, Ahmad will say that, oh, you will get at least minimum 56,000. So Bashir will take 56,000. Then the balance will be given to Ahmad. Okay, so then 75,760, 75,760. Okay, so this share of profit will be credited to the current account. Current account of the partners. So then current account, so you balance the current account. That means all this, you see which side bigger. Which side bigger? For Bashir, this side bigger, the 72,000. Then I put 72,000 here. 72,000 minus all this, I get 17440. So this is the balance carried down at the end of the year, 30 September 2008. Okay, 17. Then this is balance brought down on 1 October 2008. Then this side is this one is this side bigger, 52,000. Then I put here 52,000. This one minus everything, I get 14440. Then this one is balance brought down. So the balance brought down is the same side with the balance sheet one. So you see this one, Bashir, the balance brought down is on the credit side. So that means Bashir current account is a credit balance of 17440. So in the balance sheet, credit balance are credit 17440. But Ahmad current account balance is a debit of 1. So you are supposed to put current account balance on the credit side of the balance sheet. But it's a debit balance, so that means it's a negative in the credit side of the balance sheet. Okay? Because this is a debit, right? Correct. So you put negative, bracket means negative. So these two add together is 3,000. So the total equity is 100,000 plus 3,000, 103,000. Okay, so now we have filled in quite a lot of figures already. So fixed asset, I explained to you already. So then now, trade debtors. Okay, trade debtors in the question is in the question, trade debtors. You see, trade debtors and creditors. So trade debtors will be in the debit column. Is originally 55,000. Look at note 3. Note number 3 in the question. Okay, a check for 2005 paid on 29 September 2008 was dishonored on 10 October 2008. So what is this note 3 talking about? By looking at the bank statement for September 2008, it is discovered that the following item has not been taken into account. Bank charges 1,000. Okay, so now in the question, it says in the question, the trial balance, it says bank overdraft is 80,000. So bank overdraft, that means you take out money from the company bank account until it become negative. So bank overdraft is like you must go to the bank and ask the bank that I want a bank overdraft facility. That means you are so-called requesting from the bank. For example, I will go to POSB and then I have a POSB bank personal saving account, or I also have for example a POSB or DBS company bank account. Okay, so for example, I go to DBS, then I tell the DBS, can I apply for a bank overdraft facility of 100,000? That means this one means if my bank account, for example, your POSB, you go ATM take money, you take until zero, you cannot take some more money. The ATM card come out, so you cannot draw any more money. But if you go to the bank and apply for a bank overdraft facility of 1,000 or 100,000, say 100,000, that means when you go to the bank and draw money using your ATM card, or go to the counter and draw money, or pay money by check or something like that, your bank account can go to a maximum of negative 100,000. That means you are allowed to owe the bank up to 100,000. That is the meaning of bank overdraft. Okay, so that means this company, this Ahmad and Bashir company or business, have this bank overdraft facility. And according to the trial balance, the bank overdraft is 80,000. So that means the so-called the company or the business owes the bank 80,000. And then item number 3 in the question says, bank charges not included in the bank statement yet. So that means the company will owe the bank even more. So at first they owe the bank 80,000. So they will owe, because the bank charges was deducted from the bank, their bank account, but not taken into account taken into this 80,000 account, taken into the company account yet. So that means they will owe the bank even more. Okay, so owe the bank, so the 80,000 plus 1,000, 80,000 owing plus another 1,000 owing. And then part 3, part 2, a check 2005 paid on 29 September 2008 was dishonored on 10 October 2008. Dishonored, that means bounce. Okay, dishonored, that means the check bounce. Then how? The check paid on 29 September 2008 was dishonored on 10 October 2008. You see, I read carefully. This one very tricky. A check for 2005 paid in on 29 September 2008 was dishonored on 10 October 2008. That means what? A check for 2005 paid in to the company was dishonored, was bounced. Paid into the company. That means the person who write the check maybe don't have money in the bank account, and also don't have bank overdraft facility. So he pay, then bounce. The check cannot clear because his bank account no money, but he still give me the check. Correct? Then it won't go through. So was dishonored. So that means paid in. That means the debtor who owe me money paid in 2005 on 29 September. Then the check bounced. So when they paid in that time, I would have a minus from debtor and add to the bank balance. But now the check bounced. So then now the check bounced, then how am I going to reverse? So that means now the debtor, because when they paid at me that time, the check, I would have minus from debtor and increase the bank account. That means so-called minus from debtor and reduce the bank overdraft, minus from the overdraft. But now the check bounced. So I will go the other way. I add back to the debtor, because that means the debtor still owe me the 2005 because the check bounced. Add to the debtor. And the bank, the money did not go into the bank account. At first I minus out from the bank overdraft, reduce the bank overdraft, because I thought the money come in already. But now the check bounced, the money didn't come in. Okay, so that means the bank overdraft will increase. Okay. So that's how I get my bank overdraft figure and my trade debtors figure. So this one I explained already. Creditor is just copy from the question, no adjustment, 35,000. This one I explained already. So the whole balance sheet I explained already. The whole balance sheet I explained already. Then this one, workings also I explained already. So I explained all the figures here already. Then part D, okay, so what does part D of the question ask? Prepare journal entry to record the admission of Cherry to the partnership on 1 October 2008. So now look at the question, information number 5. Cherry agreed to join the partnership with effect from 1 October 2008. So that means the so-called the next financial year. The partnership goodwill is valued at 60,000, and in future, Ahmad, Bashir, and Cherry will share profit 40, 30, and 30. Goodwill is not to appear in the balance sheet. Cherry is to pay the capital of 50,000 on 1 October 2008, plus enough to pay her share of goodwill. Wow, this one can get sweat. Okay, so now how are this? The question just says prepare journal entry 4 marks to record the admission of Cherry into the partnership. Okay, so you see, when you first start the business, Ahmad and Bashir, when they first start the business, you know how difficult. They don't have regular customer, huh? Then probably when they first started, they don't even give themselves salary because no business, very difficult. They don't know how to do the business, so they have to learn from scratch, and then they don't have regular customer. Supplier also don't give them favorable discount and discount and this and that and everything. But along the way, this one Ahmad and Bashir, they have slogged through along the way, and after some time their business have gained regular customers, and then supplier also give them favorable discount and all this, and then people also, their business also become famous already. So generating auto revenue, revenue, so-called automatic coming. People know them, and then the customer who are satisfied with their business will keep coming back. So you think like that, it's like if you're Ahmad and Bashir, do you want to get another partner to come and share your profit or not? It's stupid, right? Why you want to, you slog from scratch until today your business is established already. Why you want to take in another partner to come and share your profit when that person did not slog with you from day one? If it's you also, you don't want, right? Correct. You don't want, right? You will ask the other fellow, why don't you go and start the company from scratch? Go and start a company from scratch, like what we did before, until we are so famous today. We are auto generating a profit. Then you come in and share our profit. We don't want what, correct? Nobody will want what. So, but so-called, but if we were to put a value, this value we call it goodwill. For all the goodwill that the Ahmad and Bashir, that means the old partners, has been developed for the company so far. So-called, they have built up all these regular customer and have gained, maybe they have even gained some political connection, and also have gained some favorable terms. The supplier are giving us favorable terms. So if we can put a value to this and make the new partner pay for this goodwill, then it will be a fair thing. Then the existing partner will agree to take in a new partner. So the question says the goodwill is 60,000. Okay, this goodwill 60,000, like what I explained to you just now, this 60,000 was generated throughout the years by the old partner. The old partner have slogged through the years and generated and bring the company to what it is today. Yeah, and they have decided that the value of the goodwill, which includes things like company reputation, regular and loyal customers, good relationship with suppliers, and so forth, so on and so forth. They have valued this to be 60,000. So this 60,000 should be credited to the old partner in the old profit sharing ratio. So the old profit sharing ratio, as explained in the question, it says that Ahmad and partner traded in partnership, and then they will share profit equally. So the old profit sharing ratio is 1:1. So the 60,000, you see, it was this goodwill 60,000 was generated as a result of the past efforts of the old partner. So this 60,000 should credited should go to the old partner. Okay, the information number 5 also say that goodwill is not to appear in the balance sheet, not to appear in the balance sheet of the company. So we credit to the old partner. So since it's not to be appear in the balance sheet of the company, so we cannot debit the goodwill bracket balance sheet, right? 60,000. So who are we going to debit to? Can we say we debit all to the new partner? You see, if we debit this whole 60,000 to the new partner, not fair. You know why not fair? Because then let's say that means if you debit all to the new partner, that means, in other words, we are saying that when we debit the capital, that means we take away the partner's money lah. That means we reduce the partner money in the company. So then Cherry will say, yeah, okay, you two have this 60,000 was generated due to the past effort of you two guys, Ahmad and Bashir. But Cherry will say, but you two guys are still in the company. You will also enjoy your past efforts that you have put in. That means in other words, you will also enjoy, in the future, you two guys will still be enjoying the goodwill that you have generated for the company because you are still in the company. Then Cherry will say, unless you sell the whole business to me, then okay, I'll pay for the 60,000 for the whole goodwill. Because you two guys won't be enjoying the goodwill anymore. But that is not the case, what? You two guys are still continuously going to be partners of the company and enjoy your past effort, which is your goodwill. So therefore, the goodwill, it should be credited to the old partner in the old profit sharing ratio. It should not be credited to the new partner at all, because the new partner did not until today, the new partner did not put in any effort to generate this goodwill. Okay, so it should be only credited to the old partner in the old profit sharing ratio, but it should be paid by all the future partners, okay, which include the old partners. That means all the new partners in the new profit sharing ratio. So new profit sharing ratio is 40, 30, 30, right? So 433. So 433, that means 60,000 times 4 over 10, 3 over 10, 3 over 10. So this how so that means so you see, this goodwill is a capital item, it's a long-term item. It's a long-term item. So you should not be adjusted to the partner's current account. It should be adjusted to the partner's capital account. It's so-called when the business bring in a partner, or the business is sold, or whatever, it changes hand, then this goodwill is long-term nature. So it should be adjusted to the capital account. So they want the journal entry, right? So now I put the journal entry for you. Some books may teach you to net it off, okay, but for me, I put the whole figure. If you want to net it off, you can, 24,000. So that means debit Ahmad, credit Ahmad 6,000, and then credit this fellow 12,000, and debit this fellow 18,000. So if you want to net it off, you can, but for me, I always don't net it off. I put the whole figure. Okay, so there's another part of the question. The number 5 also says that the Cherry will pay capital of 50,000 on 1 October 2008, plus enough to pay for her share of goodwill. So that means Cherry will pay for her goodwill in cash, so-called in check or in cash. So Cherry will pay 50,000 plus her share of goodwill, which is 18,000. So that means Cherry will pay to the company bank account 68,000. So we credit the capital Cherry 68,000. Yeah. So that means this is what Cherry paid lah. Okay, debit debit bank 50,000 plus 18,000. So some students like to net off everything and put all in one journal entry. Can also. So you see here here I go and debit capital cherry 18,000 and then credit capital cherry 68,000. So that means what is the net amount? The net amount would be credit capital cherry 68 minus 18 will be 50,000, correct? So you want to lump all into one journal entry also can, or you can put it separately like that also can. Okay, so the other question, like just now in the beginning, I tell you that we do a quite few question, but now I think too long. So I will divide this lesson into more parts. Easier for you also. You can just click whatever parts you want to view. Okay, so the next question I will do in part two of this lesson. Okay. Okay. So okay. Okay. Thanks.